Good morning, students. Hope you all are fine at home. I think all are listening to this video and learning accountancy. Before starting today's class, I want to explain one term from the terminologies, basic terminologies in accounting. One of the students has sent one message that I have left one topic, that is invoice. What is invoice? Invoice is issued by the seller to the buyer. It is issued by the seller only at the time of credit sale. To the buyer means the customer. This customer is the credit customer. If we purchase, if we sell goods for cash, that one that they will pay cash and we will issue the cash memo. But goods are sold on credit, we have to prepare an invoice. In that invoice, we have to include the description of the goods. All the detail will be there. Description of the goods, then rate, price. Then for the prompt payment, we may allow some discount for them. Discount allowed. I think we have learned this word. Discount will be allowed if they pay that credit amount within the stipulated time, within the time limit. Within the time limit, if they pay, it may be 2 months or 3 months. If they pay that month within that stipulated time, then we have to allow some discount. Then the lesser amount only they will pay. So in order to encourage them for the prompt payment, we allow this discount. So that discount rate also will be mentioned, and the net amount payable, that is net amount payable, is also mentioned in the invoice. Okay, that description of the goods, rate of the that product, then price of that one, then the discount rate will be mentioned, and the net amount. They will deduct that discount allowed, and the net amount will be mentioned in the invoice. That is the invoice. It is issued by the seller to the buyer at the time of purchasing on credit. So when the seller sells on credit to the credit customer, that invoice will be sent along with the goods. It will be sent along with the goods to the buyer. I think you might have understood. Now we will recollect yesterday's portion that we have learned. All the accounting principles. First we know what are the accounting principles. It is the basic norms and assumptions. It is the basis for preparing accounting system. And that accounting principles provide one framework within which the accounting records and the accounting reports are to be prepared. So it gives some shape for the accounting. And what is the concept? Accounting concept. We can say accounting principles, we can say in different terms, accounting concept and accounting conventions. These principles can be divided into concepts and conventions. Concepts and conventions. What are the concepts? What are the conventions? So we have learned 4 concepts. The first one, business entity concept. Business entity concept. This one, all the transactions are recorded from the viewpoint of the business. From the viewpoint of the business. Because here the business is considered separate from the proprietor. Business is separate from the proprietor. Any personal transactions are not mixed up with the business transactions. Business transactions are only entered, but some transactions, some personal transactions that affect the business will be entered. They are the capital introduced by the proprietor, then any withdrawal, that is called drawings in the term we studied, any drawings for his personal use, or any additional capital. This will be entered. Additional capital, if any additional capital is introduced in the business, that also should be entered in the books of accounts. So all the transactions are entered in the books of accounts from the viewpoint of the business. Because here as per this business entity concept, business is considered separate from the proprietor, from the owner. But the amount invested by the owner is considered as capital because that amount should be returned back to the owner by the business. Then the next concept is money measurement concept. All this I explained already. Once again I am explaining. Money measurement concept. Here all the transactions which can be measured in terms of money. All the transactions which can be measured in terms of money only recorded in the books of accounts. Any transactions which cannot be expressed in terms of money are not entered in the books of accounts. That we have learned some examples. Any efficiency of the manager, or any strike held by the employees or the workers, or any working conditions, if any bad working conditions available in the working place, all these cannot be entered in the books of accounts. Okay, that is money measurement concept. The third one, going concern concept. Going concern concept. Here, as per this concept, the concern or the organization is considered that it will be running, it will be going on for many years in future, a foreseeable future we can say. As per this concept only, that they enter all the transactions. For example, we purchase one fixed asset. We consider that fixed asset is that is used in the business concern for around 10 years. We never think next year we are going to sell that fixed asset. So that is why this going concern concept is given. So as per this concept, we conclude that that fixed asset or the business is running for many years, for a foreseeable future. It will not come to an end within a short period of time. That is why we value the fixed asset at cost price. And every year they will deduct 1% as depreciation. They will calculate, okay, this asset can be used for 10 years. So, if we calculate 10%, as per this one method is the depreciation, valuation of depreciation. different methods are available. So for 10 years, if they take 10% each year, at end of 10 years, this fixed assets value will be becoming 0. So they will calculate the number of years that can be we can use in the business concern. Then the fourth concept is cost concept. This is also related to going concern concept. Here we have studied the fixed asset are valued as per its cost, because all the fixed assets are entered in the balance sheet. They are valued at cost price. Cost price, I have told you, that is the acquisition price. Acquisition price means purchasing price. Purchasing price. We never record that one at the market price. How today, if we go to the market to sell that asset, how much we can realize, that we never consider, but we enter in the books of accounts the value of fixed assets only at its cost price. Okay, that is cost concept. Then the fifth one, dual aspect concept. Dual aspect concept. Each and every transaction has two aspects. Here all business transactions, okay? All business transactions have two aspects. One will be the debit aspect and the other will be the credit aspect. If it is debit, maybe the receiving aspect. If it is credit, that will be the giving aspect. For example, if we purchase one land, we go and purchase a land, what we get? What is debit? What we are receiving? The land. And what we are giving? The cash or bank. Through bank. Check, if we pay, if we give one check, that amount will be withdrawn from the bank. So either cash will be paid or the bank will pay. So we will credit either cash or bank. So here you see, if the land's value is 10 lakh, the cash also will come as 10 lakh. So the amount will be equal. So this is the fundamental of double entry bookkeeping system, because double entry, we are entering two aspects. One is the receiving aspect, the other is the giving aspect. Here only that basic accounting equation evolves. The basic accounting equation. Because that all the debit aspect is equal to credit aspect. We will not reduce that value, debit to 10 lakh, credit to 9 lakh, no. If there is a debit of 10 lakh, there should be a corresponding credit of 10 lakh. So the debit means all the assets, debit aspects will be equal to credit aspects. All the credit aspects are the capital and liabilities. So this one debit, this one credit. So all the assets shows debit balance. The capital shows credit balance, liabilities show credit balance. So if you add all the debit aspects and if you add all the credit aspects, it will be equal. So this is the accounting equation. Asset is equal to capital plus liabilities. If we need to calculate the capital, we can derive this equation in different ways. Okay, we need to get the capital. What we should do? From the assets, we have to deduct liabilities. If we deduct capital from assets, we will get liabilities. So we can derive many equations. But the basic equation is asset is equal to capital plus liabilities. Then now we will learn the next one. I think up to 5 that concepts we have learned. Now you listen. The next one I am going to explain to you. Periodicity concept. Periodicity concept. We know we prepare the accounts for a period, for a particular period. This may be 1 year. This period may be 1 year. Not at the end of the life of the business we never calculate that profit or loss. But that periodically we need to check the performance and the financial position of the business concern, because many people, the creditors, then the proprietor, then the management, everybody needs to know the performance of the business. But so there must be a period in the preparation of financial statement or the reports. So periodicity concept, usually they will be preparing all the books of accounts or the financial statements for one particular period. That period may be usually 1 year, maybe accounting year or financial year or the calendar year, whatever be the year. Then the next one, matching concept. What we are matching? Matching concept. Here, what is matched with what? Here, accounting period is there now. Accounting period. For period only we are going to match. So, all the revenues are matched with the expenses incurred. All the revenue that we earn will be matched with the expenses incurred during that particular period. Expenses incurred. That particular period. So it is based on the periodicity concept. And one more accrual concept also will be coming there. So now you might have understood what we are matching. All the revenue that we earned during that particular period will be matched with all expenses that we have incurred during that period is matched. Only then we could find out the correct profit. Here it is matched with the periodicity concept. Why? Because we are matching that one only with that period. Then the next one, the accrual concept. Accrual concept we are going to learn. Here I will explain. Because that expenses incurred means if one expense we might incur but we have not paid. Incurred but not paid. This also should be included in the books of accounts. Here, what is the meaning? Expenses incurred. In expense, I will explain this one with one example. Okay, that salary. Salary is related to March 2019. But we will pay this March salary on 1st April. So, this we can say that salary is incurred in this year, but it is paid on next year. Because we close this books of accounts, accounting period ends with March 2019. But we will include this one along with this expenses, along with this year. What we have, though we have not paid, we should include, that is that outstanding expense it is. Okay, that should be added. That is called the accrual concept. That accrual, that same thing will be applicable for the revenue also. Revenue, income accrued, we can say income accrued but not earned. What is the meaning this one? Income accrued but not earned. This also I will explain with an example. For example, rent received. It is an income, isn't it? Rent received is an income for the business organization. The same thing for the account period ends with March 2019. Here the rent we will be receiving only on 1st April. So we can say this rent accrued but not received. It is accrued on March 2019. That particular year's income, that is what income accrued means, that particular year's related to that year, but it is not earned. Okay, that is called accrued, related to that year but not earned. So here is an example. So rent it is that should be related to 2019 March, but we actually receive it on 1st April 2019. So we never that this is what I have explained to you in the basis of accounting. Do you remember? Cash basis, accrual basis and mixed basis. Accrue, that is the basis of accounting. There I have explained to you. Okay, so that is also included in this matching concept. So all revenue earned will be matched with the expenses incurred during that particular year, and all adjustments are made for outstanding expenses. Now I explained to you now outstanding expenses, then prepaid expenses. Any expenses if we have paid in advance, that should be deducted. If we have to pay any expense that is outstanding, that should be added. Okay, then income accrued but not paid, not received, should be added. Income received in advance. Some income we may receive in advance. So that is not related to this accounting year, that is related to the subsequent year or the next year. So we have to deduct. Understood now? So adjustments are made for these four. Then depreciation. We will provide a percentage as depreciation that should be deducted from the fixed assets. From the fixed asset it will be deducted. Then any bad debts. Bad debts, I think I have told you, bad debt is the irrecoverable debt from the debtors. Debtors means who? They are the credit customers. Some all of a sudden one of the credit customer may expire. He may not have any descendant, maybe the wife or son or daughter, no one, no relative, no property, nothing. So we cannot recover that debt from that particular customer. So that will be considered as bad debt. So this will be deducted from the debtors. So we have to provide this one. This one again I will explain later in this concept. Okay, all these adjustments should be made in this books of accounts. Right, so it is related to the matching concept. Then the realization concept. Realization concept. What is realization concept? According to this realization concept, any change in the asset, the value of asset, is recorded only when the business realizes it. What is the meaning realizes? For example, we purchase an asset, one furniture. We purchase an asset, a furniture for rupees 10,000. So it is of very high made of very high wood, teak wood or rosewood. Okay, so they now the value is increasing because it is made up of rosewood. The value increases. Even if we sell after 5 years, we could realize around 15,000. Okay, after 5 years we are going to sell this one, we are getting 15 years. But in the books of accounts, what we will do every year, around 2% will be deducted as depreciation. So first year 2%, how much? 200. So 9,800 will be there. Second year again 2%, the same fixed installment method. Okay, that one every year, not diminishing value method, that one fixed installment method. The same depreciation will be provided, 200, again 1,000, 9,600. Like that it will be reducing, but at last you are going to sell that one. We are realizing how much amount? 15,000. That is considered only at the time of realizing it, not in between. During the lifetime of the asset we cannot consider the change in value of the asset. Change in value of asset. Understood? Change in value of asset is considered only when we realizes it, not during the lifetime of the asset. For this purpose only, that I have told in the beginning itself, another concept we have learned, cost concept. We are recording the assets at its cost price, purchasing price. This is the purchasing price. We never consider the market price. Okay, there we have considered. And this realization concept, we consider the change in value of asset only at the time of realizing it. Realizing it means when we sell that particular asset, when after 5 years around 9,000 only we will be getting. That book value will be 9,000. In the book we have mentioned 9,000. But when we sell that particular asset, how much we are getting? 15,000. So how much is the profit? 6,000 is the profit on sale of fixed asset. Okay, that we can enter only at the time of realizing it, selling it. In between we should not consider the market price. Okay, there. Next concept, objective evidence concept. Objective evidence concept. Here, what related to this evidence? All the transactions should be supported by some evidence or proof. Documentary evidence must be there for each and every transaction. That only shows the accuracy, authenticity of the transaction. That means the true. That means the truthfulness. Transactions should be supported by documentary evidence. We know many documentary evidence. We know that cash receipt, pay in slip. If they deposit money in the bank, what is the documentary evidence? Pay in slip. One slip will be there, bank pay in slip. Or if we purchase on credit or sell on credit, the invoice, I have explained now, today in the beginning. That invoice will be the documentary evidence. There everything, given all the particulars of the product, then weight, then especially the amount will be mentioned. Here also how much amount is deposited, that is entered. Okay, then cash memo. If we have purchased some items on cash, Okay, then we will receive the cash memo. Purchases on cash. Then cash receipt. If we pay cash, we will receive one cash receipt. That will be the documentary evidence. That is called objective evidence concept. So for all the transactions, there should be a supporting evidence for showing its authenticity. Authenticity means the correctness, okay, or the loyalty, we can say, that accuracy, we can say. The correct amount only we can enter in the books of accounts. Then we can rely on that one. There is no fraud in that one. Reliability. Okay, all these are there. So it is one of the concept that all the transactions must be supported by any documents. Okay, then the next one. Now again 4 conventions. Now 10 concepts we have learned. Now 4 conventions. Convention of consistency. What is the meaning consistency? That permanency. Understand? Permanency. All the accounting policies must be followed consistently from one accounting year to another accounting year. Okay? All the policies are followed throughout the years, many years. That means the account to 1 year they may not, for example, depreciation is valued. Depreciation is deducted from the fixed asset under different method, valuation of that depreciation. There is straight line method, diminishing balance method, So, if we follow this straight line method for years, for many years, we have to follow the same that method only we should follow. And all of a sudden, we may not switch over to this diminishing balance method. If we start with this method, we have to follow the same method. That's why all the accounting policies must be followed consistently from one accounting year to another accounting year. Understood? But some change can be made if it complies with the provision of law. The law says all the companies must follow diminishing balance method from the next year onwards. So, okay. Then all those who have followed straight line method will switch over to this diminishing balance method. Okay. So, as per law they can change. Or to comply with the accounting standards. Some standards they have issued. Standards we are going to learn. Okay, the standards will be issued by some special organization. So if they have recommended, they can change this method. Otherwise, the same that accounting policies must be followed from one accounting year to other years. Okay, then the 12th one, convention of full disclosure. All the particulars must be, what is disclosure? Reveal. They have to show. They have to show all the transactions in the books of accounts. That must be honest. Honestly they have to reveal, not false statements. Understand? They must show they have to reveal all the transactions in the books of accounts. They may not hide any important, but that it must be fair, and all the full transactions must be revealed, and it must be adequate. Enough information must be given. Understand? Only then they can get the full disclosure in the books of account. When they calculate the performance or the profit or loss of the organization, it will be correct. Okay, so all the documents which are necessary or important must be revealed in the books of account. That is convention of full disclosure. Convention of materiality. So material information only must be shown. So you may not confuse with this one full disclosure. It is one exemption. What is the exemption? We must show all the items we are learning here, but here we say that all the material items only will be shown in the books of accounts. Immaterial, that means not important, insignificant transactions should not be shown in the books of accounts. So, for example, that they purchased one dustbin, one small dustbin. Can they show that one in the books of accounts? No, that is not material, isn't it? But one shop, they are buying and selling that dustbin. So there they must show how much they have purchased, how many they have purchased. Okay, so for one organization, one item will be material. For the other organization, the same item may be immaterial. So, okay, so that depends upon the nature of the organization. It may vary, or size of the organization, that information. As per that one, it may vary, but all the material items must be revealed in the books of accounts. That is called convention of materiality. Then the last one, 14th one, convention of conservatism. Conservatism or prudence. Prudence means we know that we